The housing market is broken. Everybody is talking about lowering interest rates so that mortgage rates will fall down and people will finally be able to buy houses. Other people blame huge corporations such as BlackRock that are massively buying houses. On the other side, you have people blaming that there is a huge shortage of houses in the market. So let's deregulate the market, more houses will be built and prices will fall down. All of these solutions are temporary. They will not fix the problem. The real fix is what the Federal Reserve just said in the last press conference.
We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term. I think the best thing that we can do for housing is to have 2% inflation and maximum employment. And that's what we can contribute to housing.
Unless the Federal Reserve will not bring down inflation to 2%, house prices will not be affordable. Buying a house will not be affordable. It doesn't matter whether you are buying that house with a pile of cash or you are getting a mortgage. Let me explain the problem. You see, if you just go back to the early 2000s, mortgage rates were as much as they are today. But buying a house back in the days was not a problem because the ratio between household income and the median house price was 3:1. Today, it's 6:1, which means that the exact same house has doubled in prices, but your household income hasn't grown much. Yes, back in the early 2000s, you had pretty similar mortgage rates. However, house prices were not so high and most people could still buy a house. Even if they did not get a mortgage, they could save for that house. Today, that is impossible. So the real question is that why exactly house prices exploded so much over the last 25 years? And that's because the Federal Reserve has been systematically destroying the housing market by intervening. You see, when you just go and buy a house and you get a mortgage, your mortgage is often turned into a mortgage-backed security and sold in the MBS market. So you have a bank such as Chase that provides 1,000 mortgages. It will take all the 1,000 mortgages and will sell them to investors as one giant security called mortgage-backed security. And usually investors would buy these securities because they are very safe investments. Now, if you compare mortgage-backed securities to the stock market, then mortgage-backed securities are much more secure. Of course, me and you, we go to the stock market because we can get a much higher return. But when you have giant financial institutions, they don't have the opportunity to take that kind of a risk like I can take and you can take. So they have to make sure that a portion of their investments is being invested in the super safe investments such as treasury bills and mortgage-backed securities. And that's why they would always invest in mortgage-backed securities. And who is going to determine what is going to be the yield on these mortgage-backed securities? Supply and demand. You have a free market. This is capitalism. This is how it works. However, the Federal Reserve, since the 2008 financial crisis, has been intervening into this market and artificially buying the mortgage-backed securities to bring down the yields on these mortgage-backed securities that made them unattractive for investors. And now it had maximized its balance sheet and the market is broken. Federal Reserve now has around $2.1 trillion at its balance sheet of mortgage-backed securities. $1.4 trillion were purchased before 2020, and the yields on them are 2.5% to 4.5%. Compare this yield to the yields that we have right now in the market, which are 5 to 6%. So you have an investor who looks at these two yields. Will they buy the exact same mortgage-backed securities that provide you with 4% interest rate or 6% interest rate? Of course, they will choose the other one. Nobody is going to buy these yields. But in 2020, it got much worse. It purchased around $1.7 trillion of mortgage-backed securities. The securities that have been purchased in 2020 had a yield of 1.5% to 2%. And in 2021, they have an average yield of 2.5%, which means that the Federal Reserve right now is being stuck with trillions of dollars of mortgage-backed securities that have super low yields and nobody is going to buy them because the current yields in the market have 5 to 6%, sometimes even maybe higher than that. So how do you empty your balance sheet as the Federal Reserve when you have so many securities that nobody in the market wants to buy? Yes, you might be able to sell a portion of these securities that have a yield of 4.5% when there are some investors in the market. However, the vast majority of these securities are absolutely worthless securities. And if you dump them, all of them into the market, then you are going to increase the yields to levels where mortgage rates will skyrocket tomorrow. The only way that it can get rid of them is by letting them to mature. So over the last 3 years, around $700 billion worth of these MBS has matured. Why? Because people are paying off their mortgages. The money goes directly into the hands of the Federal Reserve, and that's how some of these mortgage-backed securities are maturing. Secondly, people are selling their houses for various reasons. Maybe people want to move to a different state, to a different city. Maybe they don't like their houses. Maybe this house is too expensive for them. Maybe they got a promotion and they want a better house. So let's get rid of this house and buy a different house that is bigger, that is better, that is much more expensive. So when you sell your house, you pay off your mortgage, and that mortgage have been matured in the hands of the Federal Reserve. Or maybe other people are simply defaulting on their houses. You cannot make your mortgage payments. The bank comes, takes your house, sells it, and gives the money to the Federal Reserve. And that's how $700 billion of these securities have already matured. But around $2.1 trillion is still at the disposal of the Fed, and it cannot possibly sell them because the new mortgage-backed securities provide you with a 6% yields. So the real question is that how do we fix this? If we bring down inflation to about 2%, then mortgage-backed securities that provide you with an interest rate or a yield of more than 2% suddenly becomes attractive. Yes, maybe not all of the mortgage-backed securities will be sold to the investors, but all of them that provide you with 2.5% up to 4% of yield can be sold to investors. So the real question is that how are we going to solve the inflation? You see, there was already a period in the history of the United States where inflation got entirely out of control. And that was back in the 1980s. Inflation back in the days got out of control and it reached 13.5%. So if you think today's inflation is so high, then you don't know what 13.5% is. But if you want to know the truth, inflation in the last couple of years has been as high as this inflation, but you simply don't know about it. Because if you're going to be honest with yourself, then you have to understand that the way we measure inflation over the last 25 or 40 years has dramatically changed. So we use different metrics, we use different methods. So if we use the exact same measures today, the way we calculated inflation back in the 1980s, the real inflation today wouldn't be 2.7% like the last report says, but it would be something between 6 to 7%. An inflation of 2022 wouldn't be like 9% like it has been, but it would be like 15%. I've explained in one of the previous videos how we measure inflation, but let me give you just one example to illustrate the point. Back in the 1980s, we used to include house prices within the inflation report, but we no longer do that. We simply created a different measurement in order to lower down that number. But that's a story for another video. You can literally just go and watch the video I recorded. It's literally like a 40-minute video where I explain every single time we changed how we measure inflation and why inflation today is not actually like 2 to 3%, but it's much higher than that. What do you think happened to the mortgage rates? Mortgage rates have skyrocketed to over 18%. We cannot possibly have lower mortgage rates than inflation because banks are providing these mortgages. They're taking money from people who have money and lending it to the people who don't have money. So inflation is 13.5%, then the banks have provided to investors a much higher interest rate in order to attract them to invest in the banks and keep their money in those huge banks so that these banks can now provide the mortgages to people who need the money to buy those houses. So you had super high interest rates and super high mortgage rates back in the days. So the government of the United States decides to hire somebody whose name is Paul Volcker, who is going to tackle inflation and fix the inflation in the United States. He becomes the chairman of the Fed and he realizes that I don't care about anything. All I want is to fix inflation in the US, because if we don't fix inflation, mortgage rates will never come down. Like, people won't be able to buy houses, especially those who want to buy houses with a mortgage. So he becomes the chairman of the Fed and he hikes the interest rates first to about 18 to 19%. At their peak, they were even higher than 19%. So if you think today's 4.5% interest rates are high, think about the interest rates back in 1980s. They have been around 19%. I think at their peak, it was about 19.5%. He got a lot of criticism from the White House, from the Congress, but he didn't care. He understood that the only way to fix this problem and bring down inflation to 2% so that mortgages will come down is by tackling inflation. And within a couple of years, the interest rate or the inflation has come down to about 2%. Look at the mortgage rates. The same thing happens. They come down dramatically after that. So if it wasn't for the high interest rates to crush the entire economy, mortgage rates wouldn't come down at all. Yes, high interest rates back in 1980s literally caused a recession, and unemployment has risen to over 10%. It was about 10.8%, and that is even higher than the greatest crisis in modern American history at about 9.9%. The 2008 financial crisis was literally the greatest crisis in modern American history if you don't count the 1929 depression. And during that time, unemployment was 10%, or not even 10%, 9.9%. At the peak of hiking the interest rates, unemployment reached like 10.8%. Do you see the scale of that crash, the scale of that crisis, the scale of that unemployment? So the Fed has increased the interest rates in 2022 to about 5.5% in hopes that it's going to fix inflation. Yes, inflation was actually fixed. Inflation has been brought down from about 9% to about 2.7%. But this is not enough. We have to bring inflation to 2%. And we have to set the expectations of investors in the market that moving forward 2 years from now, 5 years from now, 10 years from now, inflation will stay at 2%. When investors convince at that rate, they will start loaning their money at an interest rate that is slightly above 2% because they know that they're making a real return since inflation is 2% and they're making 3.5%, for example. So they would go and buy the mortgage-backed securities at 3.5%. They will also buy them the new mortgage-backed securities that will be sold at around 3.5% yields and the mortgage-backed securities that are at the disposal of the Federal Reserve right now. However, think about it for a moment. 3 years inflation or the interest rates are about 5%, but inflation isn't fixed yet. At the end of the last year, it was 2.4%. The last report shows that it has now increased to 2.7%. So if we keep the interest rates at about 5% right now, it might take another couple of years to finally bring inflation down to 2%, and the expectations of investors about the inflation is not going to be changed. So it might take the Fed another couple of years to bring down the mortgage rates. Can we afford another 3 to 4 years? Well, I don't think so. So the only real solution would be today is that the Federal Reserve hikes the interest rates to about 10%, let's say, or 8%, and inflation comes down to 2% within a year. And after that, it starts slowly lowering down the interest rates. It might not do that instantly. However, because inflation is already at 2%, then mortgage rates will come down anyways. Why? Because the mortgage-backed securities can be sold at an interest rate at a yield that is slightly above the inflation rate. But most likely that's not going to happen because we have an environment where the President of the United States is pressuring the chairman of the Fed to lower down interest rate. Imagine what is going to happen if he's going to hike the interest rate. I think there is going to be like a civil war. But here's what could possibly happen. He will be replaced in May of 2026. We know that for a fact already. And the next person who will come and will be the chairman of the Fed, he's most likely going to lower down interest rates. So imagine if inflation is not going to cool down to 2% until May of 2026, and it will be around 3%. And then we bring down the interest rates from about 4.5%, which they are right now, to about 2% or 2.5%. And inflation gets out of control to about 4% or maybe 4.5%. Now we have changed the expectations of investors, and they no longer expect that inflation is going to cool down, but rather they expect that inflation will continue at about 5%, maybe even higher than that. So we have completely destroyed the expectations of the investors, and that might mean that the Federal Reserve might need to show decisive action like it did back in the 1980s, that the Fed is ready to take any measures possible to bring that inflation to 2%. So we might actually see very high interest rates in 2026. They might actually rise them to such a level in order to finally fix inflation, and it might cause a 1980s style recession or a crisis and will crush the entire market. That is, for now, a theoretical possibility, because for now we cannot for a fact say what is going to be the inflation rate by the end of the year, but the trend is clear. We went from 2.4% to 2.7%. So if by the end of the year it is going to be around 3% or 2.8%, then the probability of that is going to rise dramatically. That's it for today. Thanks for watching, and I will see you in the next one.